All right. Today is Monday, October 24th. This is a recap for the stock market activities today. And folks, I got a good one for you tonight, although it's going to be a little shorter because I got something to do in the evening, but nonetheless, it's going to be packed. So without further ado, here it is. In focus tonight. How about the she bomb that we got in the morning today? And then we have a new PM in the UK, Mr. Sunak. I'll give him about 2 months or so. And then we have a new pivot narrative. It goes as kinder, gentler Fed. But let's begin with China, because over the weekend, Comrade Xi got re-elected as president for life. And on behalf of the Maverick for Wall Street channel, I'd like to congratulate Chairman Xi for winning the elections. It was a tough one, really close. I had absolutely no idea how it's going to go. So congratulations for Comrade Xi for pulling a nail-biter and winning the elections. Very impressive. And of course, apparently the stock market was also caught by surprise by the elections results. The market had no idea that Chairman Xi is going to win. And now that he did, all of a sudden we have this surprise reaction, right? Like nobody knew that he's going to win. I mean, you look at the Hang Seng over at Hong Kong, down over 6% for the day. And of course, U.S. market futures reacted negatively in reaction to what's going on in Hong Kong. But putting the sarcasm aside, why did Asian equities move down dramatically? I mean, we all knew that Xi Jinping will be re-elected. So what's going on here? What is the surprise? The surprise is the fashion this was unfolded. The way Xi Jinping cemented his power over China for the next decade, 2 decades, who knows? We all saw the scenes of former President Hu Jintao getting dragged in the party congress right in front of Xi. In other words, Xi ordered him to be dragged. And if you're watching the show tonight from China and you're surprised, like what? Hu Jintao got dragged in front of the party congress? What happened here? Yeah, it did happen. It's just censored in your country, baby. You can't see it. So enjoy this show before it gets pulled out too. But back to the stock market here in the United States. Equities decided to shrug all of this off. Shake it off, baby. Shake it off. Nothing matter. You know why? Because we got the Fed pivot optimism going on in the market right now. We'll talk more about this pivot stupidity in a minute, but before we do that, something else also impacted the market in the morning, and this time around it came from the UK. We now have a new PM. Liz Truss gone, rest in peace, and here comes Sunak. You know why? Because nobody wants the job. You want to get it? Go ahead. We don't want to be blamed for the misery that's about to hit the country. You want to take the shot? Go ahead, Sunak. The UK is in an economic disaster, and whoever is in charge, it doesn't matter. Conservative, Liberal, Labour, it doesn't matter. Whoever is in charge will get the blame. So Boris Johnson, he's going to come back later on, after Sunak takes the arrows and the beating. And then Boris comes back and says, hey, miss me yet? Yeah, I was a lousy PM, but not as lousy as Sunak or Liz Truss. It's a freak show, folks, and they're going to keep shuffling these clowns over and over and over again. And who's this guy anyways? He's richer than the king. What is his qualification for being PM? How about spending daddy's money, right? When you think this guy can even read? They give you this picture. Oh, look at this. He's teaching the kid how to read. No. He's asking the kid how to read. Is that an A or is that a B? That would be a B. Oh, thank you. And look at this, Boris Johnson, he's like, I'll see you around in about, 2 months? I'll be there in your resignation speech. And what's really interesting about this new PM, he doesn't have the saliva Ukraine thing going on. See, that's the kiss of death. The moment you start wearing that saliva Ukraine pin and you're done. Your political career is over. So maybe this guy got a chance, right? He's not wearing the kiss of death. But of course, having a new PM, that excited the British pound to move higher by a little bit. All in all, it closed flat to negative. But the initial pop in the pound pushed the dollar down. And in reaction, when the dollar goes down, equities move higher. But in reality, the market did shrug off a lot of bad news. Be it bad earnings from last week, be it what happened over the weekend in China, or be it the resurgence in yields once again. The proponents of a rally, of a bottom, of whatever, the stock market pumpers, the perma bulls, they came out and said, hey, maybe we have peak yields. Maybe yields are about to go down. Maybe this is the top here. That means maybe you should buy equities. Maybe the stock market should move higher. And then yields went higher anyways, and the same people say, yeah, it doesn't matter, the stock market is going to go higher anyways too. You know why? Because now they believe in this Fed pivot bullshit, which Mary Daly from the San Francisco Fed contributed to by saying, hey, maybe we should slow down the pace of interest rate hikes. When 2 weeks ago she said, Oh, we're not there yet. It's not going to happen. Inflation is way too high. So what happened in 2 weeks? Why the flip-flop just a few weeks before the elections? Why the flip-flop on options expiration Friday? What's going on here? But it doesn't matter. Now it becomes the consensus in the market that the Fed is indeed debating whether to pivot or not. And by the way, the definition of a pivot is ever evolving. It started as, the Fed is going to pivot by cutting rates. And then it became, the Fed is going to pivot by maybe pausing interest rate hikes. And when that didn't work out, they're like, okay, the pivot is the Fed is going to slow down the pace of interest rate hikes. Okay, you want to play this game? Let's play the game. But here's the problem. Soon enough, we're going to get more data, more inflation data, and this bullshit about, the pivot is the Fed slowing the pace of interest rate hikes, that's going to die too. And then what happens after that? How about, the real pivot is the Fed being kinder and gentler. He was, what's his face? McCallan, some serpent from PIMCO, who cares? Take a look.
And I think we really are at a juncture where we're about to have an inflection point. I hesitate to use the word pivot because I'm not sure what it means anymore, but I think we are approaching an inflection point where we're going to have kinder, gentler monetary policy moving forward. And I think that will be the big discussion at the FOMC meeting next week. They're going to do 75, but I take Mary Daly as a harbinger of the fact there's going to be a very serious debate about what to do in December, and I expect to step down to 50 in December. So yes, it's a moment of kinder, gentler monetary policy to come, and I think the marketplace is having a small party. Not like this summer, where we got rebuked for that at Jackson Hole, but I think it's a justified small party right now.
So he says we're going to have a kinder, gentler. We're going to have a kinder, gentler Kylie Jenner Fed. Oh, kinder, gentler now? What the is that? Oh, we're going to raise by 75 basis points and then 100 basis points, but we're going to do it gently. And all of this bullshit doesn't matter. Folks, the Fed is a monkey dancing on the tune of inflation, not the other way around. The Fed doesn't have the authority to do whatever they want right now because they're not in charge. The Fed is a follower, not a leader. The Fed has to follow whatever inflation gives them. If the next CPI goes higher, if the next core PCE goes higher, they have no other choice but to continue to raise rates higher because they continue to chase. The moment the Fed gets ahead of inflation by raising interest rates above the rate of inflation, I'm not even saying the 8% Fugazi CPI rate. I'm being really kind and gentle by saying just do it above the core PCE. That's it. Get it at 5% and let's see what happens. But no, they want to do it kinder and gentler, and so they're doing it right now. Let's try 25 here, 25 there. And then when that doesn't work out, let's do 50 here, 50 there. And when that doesn't work out, let's do 75 and 75 and another 75. And when we realize that 75 is not working anymore, we'll do 100 and another 100 and another 100 and then 150. And it keeps going on and on and on. In the meantime, the economy is weakening. And hence, we have a stagflation crisis. And the longer the Fed waits, the longer the Fed remains in denial, listening to these morons, the riskier the game becomes. Because at some point, you're going to hit the economy with a 100 basis points hike when the economy is a lot weaker than it is right now, and certainly a lot weaker than a few months ago, when maybe it could have handled 100 basis points pretty good. But this doesn't matter to these zombies. They don't care about inflation. Inflation is not a problem to them. So they want the Fed to prop up equities and real estate valuations again. And who cares about inflation? Here's kinder, gentler once again.
Yeah, that's a fair point. I mean, we're not exactly off to the races in terms of markets. There's not some sense of certainty out there that we have the ultimate destination in sight. But it would seem even stepping down to 50 or becoming kinder and gentler is going to be to some degree dependent on getting some inflation data that's going to cooperate with that picture, no?
I think that's true, but I would not pound the table about that. I think over the last month or two, the community has started to recognize that core CPI, core PCE, but particularly core CPI, is by definition, by architectural design, a lagging indicator, particularly on the housing side of things. And the housing market has cried uncle. When you look around the nation, it is unambiguously clear that the housing market is crying uncle, but that's not going to show up in the core CPI until 6 to 12 months from now. So I think we're at a point where the Fed could, and probably will, stop pounding the table so hard that it has to see core CPI cry uncle before he can move to kinder, gentler.
So you hear Santoli hit him right away. He said, wait a minute, but isn't it all about inflation at the end of the day? So you talk about a pivot or kinder, gentler, who cares? It's about inflation. If inflation is not going down, how would the Fed even be kinder and gentler? And the response is, yeah, who cares? The Fed shouldn't even care about core CPI. You know why? Because all of these things are lagging. Housing prices are going down. Look at my own portfolio. I'm down about 20% year to date, damn it. I want the Fed to be kinder and general. First of all, where was the lagging indicator talk about the CPI and inflation back in the July report when inflation went down to zero? Remember, zero. Biden went out and said zero inflation.
What a stupid son of a bitch.
All the pumpers were on TV. Oh, the Fed should pivot now. Oh, that was not a lagging indicator. I guess when the CPI is down, it's not lagging. When the CPI goes up, it is lagging. That's how it works. And when he talks about, oh, inflation is going down, all of that crap, listen to this headline. I mean, you ever heard about the concept called aggregate demand? When prices go down, when inflation goes down, yet the mania and the insanity is still here, and we see a revival of inflation. We've seen this all the time back in the 70s. And now listen to this headline. It says U.S. consumer is soldiering on despite soaring inflation and recession risk, credit giants say. In other words, the American consumer is swiping those credit cards up and down, up and down, up and down with no mercy at all, which means that the tailwinds for inflation to stay and even move higher are here. Among them, the aggregate demand, but also wage inflation. We're not seeing a lot of job losses, so the demand is here. The moment the Fed says, okay, we're going to pivot now, I think we've done enough with inflation, get the party started. What do you think will happen? Prices will go higher again. You will see oil at 150 easily. You will see home prices shooting up higher again. And then what? Then the Fed has to resume quantitative tightening from a harder place. Inflation will go higher to 9%, and they're going to have to hit the economy with 200 basis points hikes at a time. I mean, are you people crazy? The folks who say, oh, the Fed is going to pivot, should pivot right now. They're over-tightening. What the hell are you talking about? Do you even know what you're talking about? Or are you just talking your book? And that's okay. You could come on TV and said, yeah, I want the Fed to be kinder and gentler so I can afford to buy new paintings. Anyways, while we have the inflation tailwinds intact that will keep inflation sticky, we also have recession risks. We have an economy where the wheels are falling off. Look, for example, at today's PMIs. We got the PMIs, manufacturing, services PMIs. They're all down again, below 50, while prices remain sticky. In other words, we have a stagflation phenomenon in this economy. And the stagflation continues to deepen. The gap between inflation and the pace of economic activity is widening. And if you understood what I just said, you know that this is the wrong time for the Fed to pivot. It is absolutely dangerous for the Fed to ease right now because this gap between inflation and the pace of economic activity will become even wider and bigger. And again, this is really dangerous because when you have a massive gap between inflation and the pace of economic activity, Fed tightenings does more damage to the economy. The 25 basis points that the Fed did earlier this year will be the equivalent of a nuclear bomb when the economy weakens a lot. But what choice will they have at that point when inflation is too high? This is the risk. This is why the Fed should never, ever even think about pivoting right now. The pivot will happen. But unfortunately, the pivot will happen after something breaks to prevent a collapse or a financial accident that will be widespread globally. But they're not going to know that until it happens. So again, the options are continue to tighten and push inflation down, aka do the right thing, but risk a financial accident because we have a lot of zombie companies and zombie economies all over the place. Or pivot now, please the market, please the real estate market, please the global economy maybe because the dollar goes down. But then what? Inflation will spike again. And the Fed will have to resume the fight this time around at a bigger disadvantage, not just for them, but for the economy too. And with that, folks, let's move on to cover the stock market information for you. We begin with the closing of the indices today, and here we go. The Dow Industrial Average up by 417.06 points, or a gain of 1.34%. The Nasdaq up by 92.90 points, or a gain of 0.86%. The S&P 500 also in the green by 44.59 points, or a gain of 1.19%. When we look at the sector's performances today, at number 1, capturing the gold medal, defensives. At number 2 for the silver, healthcare. Number 3 for the bronze, industrials. Meanwhile, the laggards of the day led by materials, cyclicals, and energy. When it comes to the advance to decline ratios, NYSE 64% advancing versus 35% declining. The Nasdaq 49% advancing versus 49% declining. It's the calm before the storm. One of these earnings will bomb, and then the rest is history. But for now, moving on to futures, commodities, what's going on here? The dollar went higher initially, and then it went down, and then it closed flattish by the end of the day. And this behavior will give the commodities market mixed signals, and we're seeing this illustrated right here. For example, some energy commodities are higher, some are down. Some metals were higher, and some were down. Now, when we talk about energy, the WTI and Brent down for the day, modest declines. Nothing significant here at all. But we have significant gains for the RBOB gasoline, worth about 3% for the day. Likewise, heating oil with gains of about 2.75%. And then we have natural gas. The rebound is here, baby. Up about 4.5% for the day. We'll see if this is going to stick or not. My hunch is, at least, we will see a relief rally in natural gas. Now, when we talk about energy policy, we hear a lot of criticism against the Joey B administration's policies. But rest assured, we have these two geniuses from Fortune magazine who say, ignore the analysts' misinformation, oil slick. Misinformation. Biden is making real progress on energy. I love how they use misinformation about anything they don't like. I should start using that too. When my wife confronts me, you lied about blah, 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 blah. I didn't lie. What are you talking about? That's misinformation. I'm going to report you to Twitter. But anyways, when we talk about natural gas, we all have to put our Al Roker glasses on this time of the year because it's all about the weather. If we have a warm winter, natural gas will go down big. If we have a colder than expectations winter, natural gas will explode higher. For now, the recent move in natural gas suggests that perhaps we're going to have a warm winter. And the NOAA, the National Oceanic Atmospheric whatever the other one is, agency, dummy. The NOAA winter outlook predicts another La Nina, and no end to extreme drought. And they give us this forecast that, hey, the country is going to be mostly warmer than average, so natural gas should go down. And of course, the forecast changes according to the polls, not the weather polls, the political ones. So let me fix this one for you, and here it is. Whoops. Yep, prepare to freeze. They say it's going to be warm. You know what to do. Anyhow, back to the futures. And here's softs. We have gains by OJ once again, leading the pack with gains of about 3%. And then we have cocoa futures also closing positive with about half a percentage point worth of gains. And then coffee with modest gains for the day. On the other hand, we have declines led by lumber, down a little over 5%. And then cotton, down again by a little over 3.75%, and then we have sugar down almost 1.5% for the day. When it comes to metals, we have mixed picture here. Silver in the green by a little over half a percentage point. The rest are down, platinum down, copper down, palladium down. But gold, the mature guy in the room, is pretty much flat, not giving us the go-ahead one way or the other. Gold is waiting for the dollar. If the dollar goes down, gold goes higher, and vice versa. When it comes to meats, we have gains for live and feeder cattle futures. On the other hand, we have declines of about 1.5% with the new big tech. Well, not today because it was down almost 1.5%. And then when it comes to grains, down for the most part. The declines were led by oats futures, down about 3.5%. And then we have soybean meal down about 2.25%. Soybeans down. Wheat was also down. So was rough rice, canola, and corn. The only winner for the day is soybean oil futures with gains of a little over half a percentage point. On to the big casino, the options market. What's going on here? The volume is down big, so whatever happened in the stock market today, we don't have a confirmation from options. Folks are not buying calls all of a sudden, jumping all in with higher volumes. So watch out here. We might have a trap in the making. I mean, how can you rally before these massive earnings? Apple, Microsoft, Google, Meta. What if one of them bomb? This is the risk when the market rallies ahead of these earnings. But the bears love that. The bears want to head into these earnings with the market being arrogant, with the market shooting up higher, with no concerns at all. Shake it off. Because once the market shake it off, the risk ahead of earnings becomes to the downside. Meaning, if earnings come out really bad, the moment of reality can't shake that off. You see these stocks going down big. And if these big guys go down, there's no way the S&P or the Nasdaq or even the Russell 2000 would rally alone. So anyhow, at number 1, Tesla, leading the pack with about 1 million contracts traded today. About 50% of those were calls. And at number 2, Apple, with around 670,000 contracts traded today. About 55% of those were calls. And at number 3, Snapchat, big rebound today, but if you want to buy trash, go ahead. The name traded about 550,000 contracts today. About 6.5% of those were calls. Moving on to the unusual activities that took place in the options market today, and we start with the ticker SPY for the S&P 500. Well, somebody's fading the rip here. They bought the 315 puts. It is actually likely to be a hedge because the gap is really big. I don't think somebody's betting right now in 23 days the SPY will go down by more than 17%. So it is likely to be a hedge, but anyways, they see the risk. They see that this could frizzle out if one of these earnings bomb, and maybe they want some protection here. They bought the 315 puts with the expiration date November 16th with expectations that the name could go down and lose more than 17% of its value by then. They paid around 45 cents a piece to enter this trade, all in all spending around $1.6 million. And then what about the ticker BABA, Alibaba? Down big for the day on Xi optimism, and somebody's betting for a rebound, short covering, whatever it is, dip buying. They bought the $70 calls for the expiration date December 16th with expectations that the name could go down, up by 11% by then. And they paid around $4.25 a piece to enter this trade, all in all spending around $4 million. Folks have been warning you about Alibaba and all of these Chinese stocks since last year. Stay away. Some of you did not listen. You want to buy Alibaba because you think the valuation is good. Yeah, the valuation is good, but who the hell wants to take the risk at this point? And then we have LCID Lucid Motors, and somebody betting for more downside to come here. They bought the 11.5 puts for the expiration date December 2nd with expectations that LCID could go down and lose more than 10% of its value by then. They paid around $1 a piece to enter this trade, all in all spending around $1 million. On to the heat map analysis. What do we see here? Mostly in the green, but we have pockets of weakness, big time. We have a lot of red here in a lot of significant names, and the reason is the bomb that we got from Xi overnight. I mean, it is not a surprise to anybody that Xi got reelected, but the brutality, the Hu Jintao thing, that pushed a lot of fear into the market today. And we see the names with Chinese exposure, be it the Chinese names themselves, Alibaba, Pinduoduo, JD, down big, double digits in a single day. PWD, Pinduoduo, down over 24% in a single day. The Chinese automotive companies, Li Auto, NIO, all down big. US companies with exposure to China down big. We're talking about Starbucks was down almost 5% for the day. Even in chips, TSM Taiwan down almost 4%. But a lot of chips names also suffered, like Marvell. MRVL was down. Some names managed to shrug it off because the investors in these particular names are concentrating on Fed pivot optimism, and that kind of masked the Xi fear, pessimism. So we got certain names with exposure to China, such as Apple, such as Nvidia. Those names managed to close in the green. But even names like Nike kind of shrugged it off. It was not down big. It was down almost half a percentage point for the day. Is it a one-time thing? And if it is, sure, these Chinese names are going to rebound big. We're going to see short covering rallies. But I don't think it's temporary. I don't think it's a one-day phenomenon. I think something big is happening in China. It's going to rattle U.S. companies. We're talking about Apple. We're talking about Nike, Starbucks, McDonald's, all of them. They must take the threat seriously because we fired a massive shot by banning these chips from China. They see what's going on. They know we want to turn them into Russia, and they're not going to let that happen. They're going to retaliate and hit U.S. companies in China. By the way, I did warn the members of this channel. The first video for the members in this channel, I said, stay the hell away from these U.S. companies with massive exposure to China. And I even gave names and charts and details on all of these stocks that we should avoid, if not even short. But anyways, we have positive green activities, mostly in the big caps, ahead of earnings, Apple, Microsoft, Google, all in the green. On the other hand, Meta was down, but this was for a piece of news that came out today I'm going to cover that in a minute. Healthcare did pretty good. The big pharma names, AbbVie, Pfizer, all in the green, no problems here. The consumer defensives, Coca-Cola, PepsiCo, Costco, Mondelez, all outperforming. Of course, Coca-Cola is reporting tomorrow, but I don't like it when stocks rally ahead of earnings. And Coca-Cola scored gains of about 3% today alone, before earnings. So now the bar is set really high. Coca-Cola must report really, really good earnings to live to this high bar. Otherwise, we could see a phenomenon of front-loading these gains ahead of earnings, and then we have buy the rumor, sell the news when earnings come out. Other pockets of weakness, some names in oil and gas. Once again, China fears demand goes down, more the thing lockdowns. Yet we see signs of resiliency in oil and gas. To begin with, both the WTI and Brent were not down by a lot, and a lot of oil and gas stocks managed to outperform. We're talking about Exxon, we're talking about my recent favorite, SLB, Schlumberger, up over 3% for the day? Keep printing, baby. But here's the warning. Now that I'm bragging, if you're going to jump in right now, you're likely going to eat a face in the pie in the face. So maybe you want to hold on here till you get a pullback and then hop in. But we also see China-related weakness in materials. For example, copper, Freeport-McMoran down big. Some of these China fears are overblown when it comes to commodities-related stocks, but they're not overblown when it comes to companies that do a lot of business in China, because the crackdown is coming. No doubt about it. For example, these casino companies in Macau, they're down big today for the same reason. We don't know what's going to happen. And of course, when we talk about China, Tesla becomes one of the most important names we have to cover. And when it rains, it pours. We got bad news from Tesla regarding deliveries a few weeks ago, and then we got the earnings report last week, and we found out that automotive margins are down. And then now we heard the news that Tesla is slashing prices in China by 9% because the competition is heating up. What does that mean? Their margins in China will go down. And people say, hey, Maverick, you're overblowing the story. The Chinese consumer is not shunning American products. We have a general weakness in the Chinese economy. The Chinese consumer is not spending all in all. That's bullshit. The Chinese consumer is becoming increasingly anti-American. And if they have the choice of buying a Chinese car that is comparable to Tesla at a cheaper price, they will do so. And therefore, we're seeing Tesla sales struggling in China. And soon enough, it's going to be in Europe. And soon enough, it's going to be in the US, because European manufacturers are ramping up. US manufacturers are ramping up. And Elon Musk is making a lot of enemies in Europe, in America, in China, all over the place. Part of the allure of owning a Tesla is the brand of Elon Musk. But Elon, because he shared his political views, alienated a lot of folks, a lot of Tesla consumers. Now, the man should have his opinion and not be punished. Everybody's entitled, but not in this country. And especially if you challenge the propaganda machine and you say, hey, I'm going to buy Twitter. I'm going to take your propaganda machine and buy the whole enchilada because I'm that rich. Well, now you made enemies, and these are powerful enemies with the deep state oligarchy that rules the country, which Elon should be part of, but he's being rebellious, and they don't like that, and they want to teach him a lesson. And now they say that Elon Musk is a national security risk, and we have to do all of these security reviews before we allow Musk to buy Twitter. There were no national security reviews when the man was flying all of these spy satellites for the CIA and the intelligence apparatus up Uranus on his rockets for years. Oh, there was no problem back then. But now that he's buying Twitter, we gotta shut it down. Watch yourself, Elon. Watch yourself. And he says, oh, it's a good point that we didn't see this kind of scrutiny when Bezos bought the Washington Post. You know why? Because Bezos is part of the deep state oligarchy. The Washington Post is now a mouthpiece for the intelligence apparatus up Uranus. And speaking of the deep state oligarchy, the poster boy for this organization is none other than, what's his name? Eric Schmidt, the boss of Google back in the day. Well, he got caught helping authorities writing AI laws without disclosing that he has investments in AI startups. Not surprised. There's no surprise here. This is business as usual, right? And then we have another oligarch in Mark Zuckerberg, but he's not that powerful these days. He lost, $70-80 billion? He might actually escape and become a lizard again. That would make his life a lot easier, but we got a massive downgrade from Bank of America saying, hey, stay away from Meta. This is trash. They actually didn't say that, but I'm just saying it for them. And the reason is the man is obsessed with this fantasy called the metaverse, and he's sacrificing the core business of Facebook, aka Meta, or Meta, aka Facebook. And we talked about this in details a few weeks ago. I said this is the beginning of the end of Mark Zuckerberg. If he continues in this lunacy, He's gonna go down and take the company down with him. And today, a major shareholder of Meta said, hey, Mark Zuckerberg, dial down the metaverse crap and make Facebook again. Everybody sees it. We all know that this metaverse is crap. It's a glorified video game, and that's all there is. But Mark is so stubborn. He's stuck in a bubble. He has the tunnel vision that whatever he sees, it's gonna work. But maybe he's wrong on this one. And this mistake could be lethal. And lastly, we have news from Boeing, aka the flying coffin. We have a new contract for a new airlines in Saudi Arabia, and they want to buy 80 jets. So this is a major contract, which probably Boeing will lose once again to Airbus. Just saying. And what about the heat map for the ETFs? Again, green for the most part, not in the Chinese or international markets. We'll talk about that in a minute, but we look at consumer staples, XLP, financials, be it the XLF or the small regional banks, KRE, healthcare, XLV, the traditional big pharma names, insurance names, not the XBI where the high beta biotech names are. XLV outperforming today. And of course the XLK technology, because big caps are outperforming today. Not so much in energy, although the XLE and the OIH managed to close in the green. And when we look at the theme all in all, both growth and value managed to perform equally today. Neck and neck. What does that say once again? It says we have a lot of autopilot buying. It doesn't matter what they're buying. They're buying growth, they're buying value, they're buying everything. Which means that we're one bomb away from all of this algorithmic and autopilot buying to stop. We see the human beings panicking and selling again. The market keeps shrugging off all of these bombs. But what if the next bomb is too much to handle? What if the next bomb comes from Apple or some of the China-related names? The big ones that we have here. When we look at internationals, for example, all of these Chinese ETFs are down big. FXI, MCHI, and I'm talking about stunning drops in a single day. Emerging markets down big. Taiwanese markets are down big. Even the EWJ for Japan was down today. EWZ for Brazil was down today. Who knows what China commodities trading policies, the new ones by the President for Life Xi, what are they going to look like? And will Brazil gain or lose from the new stand by Xi Jinping? We'll see. But for now, we have to move on and cover charts, and we start with the SPY, S&P 500 30 minutes chart. What's going on here? Yesterday, we talked about the reversal because we had a pattern of lower highs and lower lows. And Friday's action gave the bulls the advantage once again. The reason is they made a higher high, reversing the negative pattern. And most importantly, the chart reclaimed the support of 373.5. Today, the chart gapped up higher, and then it went down in a retest of 373.5. And the retest was so far so good, no problems here. And the chart moved higher and closed at the highs of the day. This is bullish behavior, not a bearish one. When the chart goes down in a retest of the support line and it rebounds higher, it closes at the highs of the day, this is bullish behavior. But will the bullish behavior be interrupted by a too big to ignore earnings bomb? That is the risk right now, the immediate one. If Apple bombs, the market is not going to be able to shrug it off or shake it off. If Meta bombs again, maybe the market can shake it off. What if Microsoft bombs? What if Google bombs? These names are simply too big. Apple, Microsoft, Google, not to mention Amazon, which came out with a warning after the bell that maybe we will see the phenomenon of Amazon Web Services going down, the revenues, the growth slowing down significantly, something that we've never seen before. So that is the risk. For now, the chart is bullish, but we have plenty of risk coming, not to mention Friday's PCE number. If the chart continues to move higher, we have the resistance, the soft one at 379. If the chart passes this one, we will eye 385.15, and the support remains 373.5. When we look at the daily chart for the continuous contract for the SPY, the S&P 500, the bull flag played out, and the chart managed to reclaim 3,720.5 support. And now it is battling the resistance at around 3,820, which was a previous rejection point. Does it have to reverse right now? The answer is not really, but it's going to face some resistance here. It's not going to be easy. The volume is down. The momentum indicators are firming up. So the bulls are in advantage right now. The bulls are in charge, but the bears are closing in. The bears are saying, okay, keep going higher. Keep pushing higher. The higher you go, the riskier the game becomes pre-earnings. And all what the bears need is one of them to bomb, specifically Apple. If it does, all of this stops. All of this rebound rally, all of this optimism stops. When we talk about the Qs, 30 minutes chart for the NASDAQ, yesterday we talked about the shake it off mentality. We talked about the Teflon chart. It doesn't matter what you throw at it, it rebounds higher again. We got the yields rise last week. The chart goes down to the support, aka the June bottom at around 269.29, and it rebounds higher. Then we get the crash from Tesla. It doesn't matter. The chart rebounds higher. It shakes it off. Then comes the resignation from Truss. Doesn't matter. The chart shrugged it off. And then comes the crash from Snapchat. And the chart shrugged it off too and moved higher. And today we got another bomb. The Xi scare, and the Qs managed to shake it off once again. The dip was bought, and the chart closed at the highs of the day. Now, without a doubt, this is bullish behavior. It's Teflon-like behavior. But the bears are going to argue back and say, you can look at it as Teflon behavior, but what if this is an emperor with no clothes? And that is because we're one bad earnings away from the market realizing that this is too big to shake it off, and it succumbs to the pressure. But this is a fundamental argument, not a technical one. So when it comes to the technicals right now, who's in charge? Clearly the bulls, not the bears. And here's the daily chart for the continuous contract for the Nasdaq. Once again, the bull flag played out. The support of the June bottom, 11,058.5, is intact for now. It has been retested over and over and over again, but the chart will face resistance at around 11,689. It's not going to be easy to pass above this number. The market will need all of these big cap technology names to ace their earnings for that to happen. But I say that the bulls remain in charge not because it's all the volume down or the momentum indicators are firming up, but because even if the chart pulls down right now and it goes all the way to the June bottom, the bulls will come out and argue, what if this is a reverse head and shoulder formation? And higher we go. So for now, the bears lost a lot of ground, and they must remain, what is the word here? How about diligent? Not to take risk they cannot afford taking right now. But the beauty for the bears, the higher the bulls go, the riskier their game becomes. And that gives us opportunities for trades against these big cap technology earnings. When we talk about the IWM, the Russell 2000, which has been the laggard, the underperformer so far, but is it playing catch up with the Nasdaq and the SPY? Perhaps, because the negative pattern of lower highs and lower lows are now being reversed. We're seeing a higher high and a higher low for now. If that continues, the IWM will capture 174.22 as support. But for now, without this happening, we cannot just assume it's going to happen. If the chart goes down again, we have support at around 168.90. If the chart goes above 174 and closes the day above 174.22, then you have the permission to catch this rally until it stops. But you cannot catch it prematurely because what if the IWM, as many believe, is a leading indicator that this rally is not going to last. I mean, it has been underperforming for a while now. When it comes to the Dixie, the dollar index, perhaps the most important chart to watch for now. The bears remain in charge for now because we have a negative divergence in the RSI. We have negative momentum in the MACD indicator, but they're not winning yet, and the reason is the bulls are still alive. The bulls would say this is a bull flag consolidation pattern, and the dollar will move higher sooner or later. On top of that, the dollar is keeping an important support of 111.5. So the bears can talk all they want. The dollar is actually showing relative strength by consolidation even under a negative momentum on the MACD indicator, which means once the negative momentum is over, we will see a big pop in the dollar. This is what dollar bulls are saying. Equities bears are saying, and this argument remains alive so long as the dollar continues to hold on to support of 11 or 111.58. If that is lost to support, the bears will gain significant advantage. And in last night's video, we talked in details on how to play this if the dollar indeed goes down and breaks support. When it comes to gold, what's going on here? Gold is a leading indicator for the dollar. In other words, gold is a leading indicator for equities. For now, gold is saying, hey, don't believe the weakness in the dollar, because if the dollar was going down legit, gold should have popped higher above 1,671 and recouped that as support. It didn't. Couldn't make it. It reversed. But of course, gold bulls, dollar bears, equities bulls, same thing. They will say, hey, the double bottom is still intact. Maybe this is the first attempt. We have many attempts to come to crack above 1,671. But as I said last night, this argument goes out of the window once the double bottom formation is gone. And here's UK oil, Brent, a daily chart. What's going on here? We have consolidation. The bears would argue this is a bear flag consolidation pattern. The bulls would argue not yet. This remains an ABC pattern in the making. Who has the better argument right now? Well, check out the MACD indicator. Check out the RSI. It appears that the bullish momentum is flattening. It is weakening, but we don't have a confirmation yet that it's gone. We'll get that once we see red impressions on the histogram of the MACD indicator. For now, we don't have that yet. And for all you know, this could be consolidation before we see a resumption in the bullish momentum on the MACD indicator, and that keeps the ABC pattern argument alive. It goes out of the window the moment we see a closing, daily closing, and the MACD indicator turning red, aka negative. And here's the daily chart for the 10-year yield. What's going on here? We talked about the shooting star on Friday, but it needs a confirmation. For now, we don't have a confirmation, so the shooting star lives alone, at least for now. It appears that yields are not ready to go down yet, so the shooting star could be a trap. And the confirmation of this is the TLT. Look at the weekly chart for the TLT. Look at the chart and think, are you seeing any indicator that the bleeding is about to stop? I don't see anything that says, okay, the bleeding is about to stop. At least not until we get down to the support of 87.94. So if this is going to be a free fall until then yields go higher. And here's the VIX 4 hours chart. What's going on here? We got a pop higher in the day, but then the VIX went down and it closed pretty much at the gap, if not slightly below. Now this behavior is slightly bearish for the VIX because it did close below the gap, technically speaking, but not by a lot. And on top of that, we have a little bit of a hint in the MACD indicator that we're starting a new positive momentum, new bullish momentum in the VIX. Not conclusive yet, but if it continues, and it should start telling us this by tomorrow, if we see the VIX rebounding higher, then we have a confirmation this will be new bullish momentum for the VIX. All of this energy the VIX has been gathering under negative/bearish momentum will be released to the upside instead. So watch out here. Whatever we got today in the market, it is not conclusive. The market may be rallying, but the market is rallying with blindfolds on. And here's Apple, the daily chart. What's going on here? We're back at the battle of 150. And I said this last night, the bulls are not going to stop now. The bulls are not going to give up without fighting the 150 fight once again. Round number 2. They got the momentum this time around. The volume is below average. The hour side, the MACD, all positive. So Apple bulls have the equipment and the tools and the ammo to fight 150 once again. They got all of these weapons from NATO, and they're closing back in, and they're regaining territory. But what if bears don't put up a fight? What if bears pull back strategically and invite them in? You want 150? Take it back. And better yet, keep going higher and higher and higher until you get to earnings, and boom, comes the surprise. Anyhow, Tesla. 30 minutes chart. What's going on here? Another gap down. Yesterday, we talked about the bullish, flaggish pattern played out, but it did not recapture 217.88 as support, and it did not close the gap. This is bearish, not bullish. The chart goes down. It loses 206.86 in the morning, but here comes the dip buyers, and the chart makes it by recapturing 206.86 as support. But not only that, it managed to close at the highs of the day. Now, is this bullish or bearish? This is bullish behavior. The problem is, Tesla did not close the gap again. If it pulls back before closing the gap, then in all likelihood, it's going to go down to 206.86 and the retest will fail, and Tesla will make lower lows. But keep this in mind. When we move out to a daily chart of Tesla, what do we see here? Look at the MACD indicator, look at the hour side, oversold, and we have the bearish momentum peaking, and we might see a reversal in the MACD and the beginning of a new bullish momentum. But what if we have further downside to go before that happens? If that is the case, we look at the chart, and we eye zones with multiple reactions. What I see here is, look at this, number 1, number 2, number 3, multiple reactions within that zone. And when we close in, we find out that 180 is an important number in this chart. So if the chart has further downside to go, it will go down to 180. And by that time, the chart will become extremely oversold. You got to be a fool not to buy it for at least a rebound rally. And this is what the bulls should be hoping for. You should be hoping that Tesla goes down all the way to 180 before we get the rebound in the MACD. Because if the chart rebounds right now and it fixes the oversold conditions by a rebound at this moment, what happens if the chart stalls at the next resistance at around 219.80, which happens to be a gap? Now we have another resistance above it, but the point being here, if Tesla rallies higher from this point on and fixes the oversold conditions on the RSI and the MACD, it might produce a mini rally, and then we see an aggressive move to the downside. And therefore, I say the bulls should be hoping for a pullback all the way to 180 sooner or later, and then comes the big rebound. Otherwise, this will be yet another dead cat bounce and then down we go. And lastly, what about Bitcoin? What's going on here? Within consolidation, no update here. It did retouch the upper range of the consolidation pattern, the launching pad, as I say. But even if that happens and it passes the launching pad, we have 20,000. So no update here until we see either 20,000 or 18,000 broken. So let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the Case-Shiller Home Index, and then we have the Consumer Confidence Index, but the majority of the action will be in the earnings calendar. And tomorrow is going to be a big day because we have Coca-Cola, UPS, GM, Google, and Microsoft. Now, we talked about Coca-Cola in the heat map analysis. The risk is to the downside. The name is up over 3% before earnings. That is a risk. UPS, the likelihood is perhaps it is overpunished, and business is still hot. We might see the stock moving higher. Then we have GM. I don't know what's going to happen here, honestly. The name is down big since the top, but if they're not selling cars as much as they should because they're busy building all of these EVs, it is what it is. When it comes to Alphabet, I know for sure that the ad business is slowing down. About a year ago, we were making a lot of money from these crypto ads. Not anymore. Now the ads pay for nothing. So I see the slowdown as a YouTuber. The assumption is we should see a slowdown in YouTube revenue when the name reports after the build tomorrow. But the big one, in my opinion, would be Microsoft. Now the name is hitting into earnings, overbeaten, bruised, so the risk is to the upside. But what if the fundamentals come out weak? Number one, the dollar has been surging higher. This is bad for Microsoft. Number two, we got a lot of warning signals of the layoffs, of the slowdown in the cloud business, Azure. And I say the risk to the market all in all is not Alphabet. It's Microsoft. And the reason is, let's say Alphabet bombs because the ad revenue is down. This is not a surprise. We got the news from Snapchat last week. We already know that the ad business is slowing down. But what if software? What if cloud? What if services slow down in Microsoft? Everybody says, okay, goods are slowing down in the economy, but services remain hot. So the surprise here is to the downside. And therefore, I say Microsoft is the risk, not so much Google. But anyhow, this is only my take. You can have yours too, to each his own. But for now, this is all I got for you. Thank you for listening. Thank you for watching. Now we'll talk to you again tomorrow. Take care.
From a financial standpoint, you are now in heaven.